Yeah, just to to echo what Todd is saying, this is a $32 million project, of which 26 million is hard construction and 6 million is soft costs. And that of course includes interest reserves and operating deficits.
Right.
So, I mean, you're getting a loan for what? For, 22 million maybe or something like that?
We're pushing higher proceeds. We're trying, part of our soft costs also, we're paying ourselves a developer fee, but we're pushing as close as possible to about 25 million in loan, and we want to come up with about 7 million of equity.
Where is it again? Amr, what part of Michigan?
Sterling Heights.
Sterling Heights, okay.
Sterling Heights, Michigan.
And you already have the land locked down, right?
Owned the land for 5 years.
Oh, that's right. Wow. Okay. And with these development deals, it's the lenders will consider the purchase of the land as part of your equity contribution.
Absolutely. And they will consider your developer fee as part of your equity
Right.
contribution.
And all the soft costs to kind of the vertical or the horizontal costs that you have to spend to get the land ready, shovel ready, that's considered part of your equity contribution.
Yeah, we haven't done any horizontal development. We haven't done any underground or any utilities whatsoever. It's still a greenfield right now. We don't want to really tap into it until our loan is ready. We're pretty close on getting our loan approved through loan committee with the bank that we're going. So I think 45, 60 days we might be ready to have a shovel in the ground. Our contractor is pretty much locked up on a budget, not on a contract just yet. We're just also really keeping a very close eye on this tariff situation right now.
Oh, the tariffs, yeah. How could that impact you? Because I guess he's tariffing everything now, right?
So far, I have an article on what may be affected by tariffs. Our biggest effect is going to be lumber.
Lumber, I was about to say, yeah, yeah, yeah. And maybe steel. I mean, aren't there's a tariff on steel as well, right?
There sure is, but we're doing a pad build, so we're going to be ground level pad with the stick building 4-story. That's what we're doing. It's a total of 5 building sticks. So the majority of our work is lumber.
Lumber, got it. Yeah,
Not a steel construction building.
got it, got it. Interesting, interesting. And Benoit's been updating his website. I think it looks great. We got his LinkedIn profile up and running with which Amr, I think you're next to get that done. And it looks really good. And did you see? I shared one of your posts, and one of my client contacts at Massive Capital was like, "Hell yeah, welcome, Benoit."
Yeah, no,
Yeah,
I haven't seen it, but yeah, thanks.
yeah. I mean, I'm telling you guys, this is where the magic happens. This is where, this day and age, if you're not pumping content out there, people don't know who you are. And it just, as soon as you get the spigot on, you'll just be amazed at how quickly, I mean, look at, I mean, I'm a great example, right? I had no Instagram account a year ago, and now I've just been busting it for a year. And yeah, I've got, the mentorship is one sort of avenue of revenue, but all the contacts that I've gained along the way have just been phenomenal. Right. And it's just by, I have a call with a guy next week as a family office in Chicago. Huge source of capital, $100 million of money to throw around. And, he was like, yeah, I love your content. You're like one of the only guys on Instagram that actually talks about like, real issues and real deal problems and real legal strategies and solutions. And he just wanted to have a call. So we just, shot the breeze for 30 minutes. Come to find out, he's a part of the family office club. He's got, lots of, he's got like a $15 million pref position in a hotel in Miami. So he's got all these irons in the fire. So you just never know where it's going to lead. So I highly recommend consistent, just content creation. Dante's was doing it, hitting it hard, but he kind of paused it. But the problem is, this is the issue. If you pause it, you kind of get punished by the algorithm, which is really frustrating.
A slave to the algorithm.
Yeah, we are all slaves to the algorithm. So if you start posting consistently twice a day or whatever, and you're interacting with the algorithm or with other members of the social media, and you stop, then the algorithm will like just go somewhere else, and it'll stop pushing content towards you and stop, suggesting you to other profiles and things like that. So it's a catch-22, but I feel like it's worth it.
Hmm.
All right,
I mean, yeah.
go ahead, Benoit.
Um, so you're saying, yeah, yeah. I mean, I've been looking, especially when I was the past few days when I was looking at my website, I try to look at all of other similar website multifamily, man. And I mean, the more I look, I mean, there's tons of people out there doing syndication. I mean, there's a lot of multifamily syndication. And I've seen it now. I'm getting on Facebook all the time. I mean, there's probably like, you know, 25 or something, like just in the last few days, like deals or like that I'm
Mm.
getting, right? So I'm like, wow, there's just a lot. Um,
It's like what, 4 billion eyeballs a month? I mean, think about the odds of that, right? I mean, there's 4 billion eyeballs a month across Instagram and Facebook at least. LinkedIn's a little bit less, but they're out there, man. It's out there. It's right for the taking.
what do you mean eyeball?
Well, like that's how many viewers view
Oh,
that content.
4 billion.
I think so, yeah.
Oh, yeah, yeah. But what I'm saying is that there's a lot of those. I mean, it seemed like there's a tough competition, right? I know this guy contacted you, but like, it's not like, not like we're the only people.
No, for sure. I see your point, Manuel. Yeah, there is a lot of competition out there, but there are a lot of investors, right? There are a lot of people out there that are looking for passive income opportunities that don't want to, they don't want to deal with tenants and toilets and, tantrums by residents, right? They want to just invest their money and realize the return and, um, you know, that's it. They don't want to get into the sponsorship piece of it. So you got to think about what is the goal of using social media. The goal is to find investors, right? And I mean, Amr, you may be a good person to chime in on this. I mean, you obviously have a stable, cadre of investors. How did you develop that list? Is it just personal relationships?
Being here on the streets, I mean,
Yeah,
and attending not just old school, attending networking events, etc. Not a single one of my investors came from any social media efforts because I don't have any social media.
right,
I mean, here and there, I randomly post projects that I'm either in the works or I'm working on, but I'm not on social media out speaking to a captive audience for
right.
this captive audience to contact me. So it is strictly just within friends and friends of friends. And I would say probably my investor pool that I can really rely on. And I know that they're just not spectators, but they're willing to participate and willing to cut checks. I would say it's probably a total of about 30 people.
30 people. Yeah. Well, that's all you need, right? I mean, 100 grand from 30 people, that's 3 million bucks pretty quickly. And so this webinar that I'm presenting at tomorrow, um, it's this group called Momentum Multifamily, I think, out of Texas, and I've been consulting with them on some 1031 things. This is a lead funnel for them. They're having a webinar for their group, their customer service, customer retention management, everyone that's in their email database, and this is how they're nurturing those leads. So, yeah, get on as quickly as you can would be my recommendation.
Send us the invite for that in the chat, please.
I will. I definitely will. Let me see if I can.
It's at 1 o'clock though, right?
Yes. Yeah. Let me find it here. Hang on. These guys do a lot of LinkedIn marketing. see. Link is in the comments. Let's see. Yeah. All right, let me throw that in the chat. Here we go. There it is. All right. I can share my screen here. All right, you guys can see that? All right, perfect. So I put together this little presentation for just to kind of go through some investment terms and concepts for commercial real estate investors, right? These are kind of just, it's like an alphabet soup over here of the terms, the relevant investment terms, financing terms, property valuation terms, and strategies that you just need to really know and be aware of as a commercial real estate investor. And we can move through this pretty quickly. And most of you, have heard of these or know these in some capacity. And if not, this will be, if so, this will be a refresher. And if not, then, we can talk through it. So NOI, everyone knows what NOI is, right? That's the driving factor of analyzing a deal. The net operating income. So it's essentially your income minus your expenses, and gives you your NOI. Now, it excludes debt service and taxes, and so there's a difference between NOI and cash flow. NOI is just income minus expenses. Once you then deduct your debt service and your taxes, that gives you your true cash flow, right? So that's an important distinction. A lot of people will see NOI and they'll think that's cash flow. You got to still take out the taxes and the other expenses for that. Cap rate. I used to not be a big believer in cap rates, but now I am. I think it's important to value a deal as compared to other deals, right? But I don't look at it as a really good metric to realize the return, like the return on the investment in a deal. Some people may disagree with me, but a cap rate is the ratio of property's net operating income to the market value, and it is used to estimate a potential return on the real estate investment. But the reason why I don't find it too useful is because the cap rate is fungible, right? You can increase or decrease the cap rate by just increasing or decreasing the price of the property. But what I do like about it is kind of knowing what is the market in this particular area or this particular asset. So, we're looking at multifamily in Atlanta. We know what cap rates are selling for, 6 to 7. If we get a deal at 8 or 9, obviously it's a home run. But if it's at 4 or 5, then it could be it'd be overpriced. And you can use that rationale to really go back to the brokers and negotiate with them and say, look, this is not in line with the market cap rates for these deals. Loan to value, what is your LTV, right? That's the ratio of the loan amount to the property's value. And it's really an assessment that you need to know of as sponsors and operators, but also it's how your lender is going to look at the loan, right? So if your loan is, if your property is going to be purchased for $1 million, you're going to get an $800,000 loan, then your LTV is 80% in that instance. And that's going to be a way to factor in or sort of back into what equity you need to bring to the table, is looking at that loan amount. So what is the internal rate of return? The discounted rate of return that makes the net present value of all cash flows from a commercial real estate investment equal to 0. That's the internal rate it's kind of a mysterious return metric in my opinion, because it takes into consideration not only how much money the investor is going to receive, but also how quickly they're going to receive it. So that discounted rate takes into consideration the velocity, right? How quickly they're going to get their money back. So the faster they get it back, the higher the IRR is. The longer they get it back, usually the lower the IRR is. What is a gross?
Can you say more about investment equal to zero? I'm not sure I'm getting that part.
Yeah, that's I think what that's referring to is how do you discount that? Um, and honestly, I don't know 100% what they're actually talking about. So I'm not sure, honestly.
Mhm.
Um,
I
cash flows
mean,
investment equals to zero. I guess that's the net present value. I guess what I think it probably means is how much you need to discount it to get it to zero.
Let's say the equity that was required for a deal is $1 million, okay?
Yeah.
The it's the velocity of how long it will take for the investors to get back their $1 million, and that $1 million is that zero marker because they're basically no money, no equity into the deal anymore. They've received all of their money back up to a zero value equity in the deal.
Right, but then, so what does that mean? So if it takes 3 years to get their capital count down to zero, then you're just discounting that return by 3 years, whatever that number is.
Yes.
So if you're returning 20% a year, I guess you back out, you take out 60% then to get to that number. It sounds like, right? 20, 40, 60.
I don't follow.
Yeah. See, this is why I let the model speak for itself. And if you ever ask like Chat GPT, hey, show me an IRR calculation, it's very complicated, right? It's very complicated math. But I think from an investor standpoint, they like to see the internal rate of return because it is sort of a holistic view of the health of the investment and the returns on the investment.
And usually, I mean, as a rule of thumb, to really explain IRR in layman terms, what is IRR versus a cash on cash? The IRR is taking the principal pay down of debt, if there is debt on the property, and considering that as a return in addition to the cash flow distribution that you're receiving from the property. So the principal pay down is a component that you're building equity into the deal because the principal pay down is a product of IRR in addition to the distributions of the net cash flow that you are receiving. Cumulatively, those two combined is an internal rate of return. So like
Right.
if you have investors in the deal, they may not be realizing the principal pay down until a capital event takes place, such as a refi or a sale. But it is money that's sitting aside for them in a separate bucket beside the monthly or quarterly distributions that they're receiving from the real estate.
Yeah, that's a good way to look at it. Thanks, Summer. That was good.
but you don't realize, I mean, you only realize the IRR when those capital event happen because until they do happen, I mean, it's just sitting in a bucket that you don't have access. So whether you're gonna sell in 5 or 6 years, like it's gonna affect the IRR, right?
Yeah.
Like say if your plan is 5 years, you're saying IRR 20% in 5 years. I mean, what if you sell year six? You know, we don't know. I mean, I'm sure there's a way to calculate what would happen with that IRR, but it's going to be different, right?
It would be how much you've paid down in year six, how much you've received in distributions in year six, and it would be averaged out to what the IRR of the investment is,
Hmm. So it could actually be better
or worse.
because I thought the longer,
Yeah,
you
I don't
know,
think it would be better. I mean, because the longer it takes to return the capital, usually the lower the IRR is. But I guess it depends because if you sell it in year six, but you sell it for a heck of a lot more, right, than you would have sold it for in year five, then it could be higher, right? Right? Maybe there's some economic event that prevents you from selling it in year five, and in year six you sell it for double what you thought you'd sell it for in year five. So it really is just kind of a fluid metric.
hmm.
Gross rent multiplier. I don't see this a lot, but it's the ratio of a property sale price to its gross annual rent income. I don't see that a lot on deals, honestly, when it comes to valuation. Vacancy rate, percentage of available commercial space that's occupied. Obviously, what's the vacancy rate on a deal? You know, if you've got 100 units and 10 are occupied, 10 are vacant, then you've got a 10% vacancy rate. Vacancy is super important when it comes to valuing real estate and figuring out what your value add is going to be. Okay, let's see. Some of these are pretty self-explanatory, right? But mortgage loans, traditional bank financing, fixed rate, adjustable rate mortgages. What are commercial bridge loans? I do get a question quite a bit about what is a bridge loan? What's the difference between a bridge loan and a hard money loan? And so that's an important distinction. Bridge loans are definitely short-term financing options. They usually provide renovations, the cost of renovations, and it's a bridge. It's a bridge to long-term financing, right? So it's a strategy to execute a business plan. You want to use a bridge loan to get to a long-term financing strategy. Now, that could be a long-term mortgage loan, from a traditional bank. It could be a HUD loan. It could be a CMBS loan. But it's a bridge to a longer product. Hard money loans are, if you're digging into hard money loans, then your deal is what they say has hair on it, right? It's typically something that is the last resort for financing commercial real estate acquisitions. And a lot of lenders who are in the hard money space, they charge a hell of a lot of fees, and their rate is usually pretty high. I'm talking 12 to 15% interest rates. And they can close very quickly because all they do is they look at the value of the property. If your property is valued at $5 million and you need a $2.5 million loan, 50% loan to value, right? I think we learned that over here, loan to value. Then you're going to get a hard money loan, and because the way the hard money lender looks at it is, well, if there's a default, then I can just foreclose on the property and I'll be fully secured. They typically have personal recourse liability on guarantees. And I've done a bunch of hard money loans, not only representing hard money lenders, but also representing borrowers and hard money lenders. And they have their place in the market, right? I mean, if you need to save a property or rescue a property and you need quick financing, then you can go get a hard money loan. You just better have that exit strategy on the back end, once that loan matures. What's a real estate investment trust? These are public and private investment vehicles that can pool their funds and diversify portfolio. REITs in our world, REITs don't really come into play. REITs don't really come into play unless you are borrowing money from a REIT, right? And they have very specific tax requirements, and I can't get into it now, but it's like they have a limited amount of investors. They've got to distribute all their profits. And so it's not really, now the public can go invest in a REIT and it's like investing into a stock, right? That you can get stock-like returns by investing in a REIT, but the REITs that we'll deal with are typically like vehicles for borrowing money from them. Commercial real estate crowdfunding. This is another form of syndication, but this is something Grant Cardone does, and some other, Yield Street, I think, is one, and I can't think of another one, but this is a model. This is a platform where these crowdfunders can go and raise like $1,000 checks, right? And $500 checks or $10,000 checks. And so that they can accept a lot lower dollar amount, but the problem with crowdfunding is that it has to be fully baked by the SEC first. The SEC has to review it, approve it. So it takes a long time to raise that capital that way. And then I just don't know why you would deal with that headache. I mean, you've got, you could have, say it's a $3 million raise, you could have, 200 investors in that. And that just seems like way too much asset management risk. There was actually a big crowdfunding in the news recently. I think there were some big fraudulent scheme of a guy using crowdfunding to go fund deals, and he just was funding his own lifestyle. And then commercial real estate syndications is what we're all about. That is essentially a partnership. You guys know what that is, between the sponsor and the capital provider. Property,
Hey, Todd,
yeah,
can you say a little bit more about the bridge loan? I mean, like
yeah.
what kind of percentage, how does it compare to a traditional loan here?
Yeah, good question. So bridge loans can be anywhere from, you know, they're typically higher leverage, I would say, 70 to 80%, would be typical. The interest rates are generally they're more expensive than a long-term debt product. So they're more expensive than a traditional mortgage loan, more expensive than agency financing. But the purpose of it is like you will use it to fund renovations. Like take Dante's deal in Milledgeville, for instance. We're getting a bridge loan for that deal. It's 80% loan to cost, or loan to value rather. Plus, there's like 200 or 300 grand of renovation money that they're going to fund, right? Because they want to fund the renovation. They want to get to the stabilized value, and then we refinance them out into a long-term agency product.
I mean, why not do that from the beginning?
Well, because the property doesn't qualify, right? So
Oh,
in order to get agency financing, remember, it needs to be 90% occupied for at least 90 days. And if the property doesn't meet that standard, then you can't get an agency loan. And then if you can't get an agency loan, then you go to the next best option. Bridge loans, traditional mortgage loans. I don't like traditional bank loans because there's always a personal guarantee associated with it. Some people are not fazed by that, or they'll just sign personal guarantees left and right, but it's just a level of risk. Like, you don't have to take it, so why bother? But that's why, Benoit. Yeah.
I've never done a bridge loan, Todd. Bridge loans are non-recourse?
Typically, yeah, bridge loans can be non-recourse depending on the lender. Absolutely. And I would say typically they are. Like if you're going to Arbor or Walker and Dunlop, I mean, the loan we're getting for Dante's deal, it's a CBRE loan, and it's a bridge product, and it's non-recourse.
like, say, I mean, that happened last week, right? Or 2 weeks ago. I saw this property near, um, near Lakeland, right? And, um, the guy just renovated, but then I just find out, there's no tenant right now. It's kind of empty, right? But he just renovated the whole thing and then want to sell it for like 80,000 a door, right? Which seems a very good price, right? So then he had me, I mean, he thought I was able to get some other type of loan, but then we talked to the broker, and then, I mean, the old broker just ended up saying I could get a loan, like a typical loan, at like 8.5%, So why was he offering me a traditional loan at 8.5% when there's zero, when the vacancy is 100%?
Why was the seller offering you the bridge loan? Or
Well, in my understanding, it was a traditional loan.
the seller was offering you that to you?
Well, the broker that was working with the mortgage broker that was working with the seller.
Oh, there's Manesh. Oh, hey, Manesh. Um, yeah, I don't know why. Maybe, sometimes these brokers, man, they don't really know. They know the brokering game, but they may not know the financing game. How many units was that, Benoit?
6,
What was the price?
like, I mean, 80,000 a door. So I don't know. That'd be like 2.4.
Okay, so yeah,
I don't
because
know.
the other thing with agency financing is you have something called an SBL loan, small balance loan, and that is specifically for smaller deals. I think the minimum loan amount does need to be $1 million for that. But he may just not have known about agency financing. But the number one game in town, if you have a deal that's stabilized or at least 90% occupied, is you want to go with agency financing. An agency is essentially a public-private partnership between Fannie Mae, which is kind of a quasi government run entity, and traditional, like what they call designated underwriting and servicing lenders, DUS lenders, that that will make these loans. But if it's agency financing, typically it's higher leverage, it's lower interest rates. You have long, like interest only periods, right? So you've got sometimes 5 to 10 years of interest only, but it's amortized over a long period of time. So they're very, very attractive loan products for multifamily deals. So good question. And Manesh, we're just going through this PowerPoint. This may be, easy for some people, but otherwise we're just going through these terms that are just kind of that come up in commercial real estate investing. Obviously, everyone knows what property valuation is, but do you know the different types of value, right? You've got the assessed value, which is typically determined by the tax assessor's office, usually much, much lower than the fair market value. And then you've got an appraised value. And the appraisal value, there are different types of appraisal values. There are as-is value, right? Like, again, taking Milledgeville, for instance, we've got an as-is value. Then we have an as-stabilized value. And what does that mean? That means after the property has undergone its renovation and the business plan has been executed, the valuation is going to go up because you're going to increase the rents, you're going to increase the amenities. And so the appraiser then takes a look at that and says, okay, what's that valuation at that point? And can someone tell me the definition of what fair market value is?
How much it trades for on the open market?
Yeah, essentially, but the legal, what we say is like what a willing buyer and a willing seller would pay for it, right? What a willing buyer would buy for it, a willing seller would sell it for. Which is kind of crazy because if you've got a property that you think is worth $5 million and somebody comes around and gives you $10 million for it and double what you think and you close on it, then that establishes the fair market value of that property, as opposed to having a professional opinion. Investment returns, just to give you an idea of average annual returns for different types of assets. We primarily focus on multifamily here, but retail properties are a little bit less, office properties are a little bit less. Industrial has been an asset class. I've got quite a few industrial clients as well, and it just continues to outperform. Because that space is just not going away, even with the gig economy and everyone working online and things like that now. But there is still a huge demand for industrial properties, data centers, stuff like that. So I have one of my big industrial clients. He probably acquires, I'd say 4 to 5 deals a year through syndications. And have you guys ever heard of like flex space?
Yeah.
Yeah, that's another asset class that is pretty hot these days. That's basically taking kind of an industrial warehouse facility and kind of turning it into custom use, I guess. I toured one in Austin, Texas once, and it was like these giant containers in like an industrial building, but then you could use it for whatever you want. Like some people stored their cars there. Some people had offices there. Some people just had junk there. It was really interesting.
Or it could be somebody like, for example, a landscaping company that has a couple of mowers and they just need a place to store their equipment and run their
Yeah,
business.
exactly. Market analysis, again, another key critical part of commercial real estate investing. Market studies, we talked about that. I think I've got a slide up on the Classroom platform of how to do a market analysis, analyzing the data, vacancy rents, rental rates, absorption rates, transaction activity. The demand drivers, if you're looking at the local market, identify the primary drivers for commercial real estate in that local market. It's usually job growth, population growth, our business is expanding. I know one particular client of mine, he only focuses on MSAs that have 250,000 a population of 250,000 or more. So that's larger cities, right? He's not going into tertiary markets and things like that. I'd like to hear, Manesh, if you want to chime in on this, what is your buy box when it comes to your location? He said he was on another call, so he may not be able to answer.
I'm sorry, I was trying to mute. I couldn't mute. My buy box was 150 units and above in states which would allow evictions to happen easily, but it has shifted significantly because the deals are just not there in states like Florida, Georgia, South Carolina, North Carolina. So I have shifted to looking at states like Tennessee, Alabama, and Kentucky, and Missouri, and maybe Illinois, Indiana, and I am looking at anywhere from 50 units to 200 units, but I am steering clear of MSAs that have anything above a 500, maybe 500,000 in population, simply because they are attracting a lot of capital. Like if I go to look at deals in Atlanta or Nashville, um, I, the valuations are still ridiculous. I'm not able to underwrite for a conservative number. It's mostly
Yeah.
pro forma numbers, and so I'm actually, like my current property is north of Memphis, so I'm always looking at tertiary markets, mom and pop situations, which like they're so desperate to sell that they have seen that unless they give at least a 7-8 cap, they won't be able to find a serious buyer.
Right. You said markets of 150,000 population or less?
Less than 300,000, yeah.
Oh, less than 300,000. Okay.
Yeah.
Actually, I got a question for you. Is it foolish to say that I'm not looking at real estate opportunities on a national level like you are, and I'm just focused on the state where I live?
So
No.
the problem is like, I'm sorry, Todd, go on.
No, go ahead, Manesh, go.
So I spent 3 years looking in my backyard. I'm in Fort Lauderdale, and in fact, my backyard is also, so for a few years was Todd's backyard in Atlanta. And
Yeah.
the problem that happens is, you know, you might know everything about your market, but you're not comfortable with the returns that these properties are willing to give you. And like my current property is 12 hours drive away. I love it. I love the concept that it's in a place where the money just comes in automatically because my basis was so low. I couldn't get that basis in South Florida. Here it's like $300,000 a door. Everything is on pro forma numbers, and there's no cash flow in these properties unless I mean, you buy it at substantially low, I mean, you promise your investors substantially low returns. But in these kinds of esoteric markets, you can see 90% of your money is made on the basis, right? If you go in with a good basis, that's it, right? You're gonna make money on that deal no matter what. So if that's what my thinking is, of course. I mean, everybody has their own thinking, you know. So if I go national and start looking at markets where they're able to afford me a higher cap rate and low basis, that to me is the biggest anxiety reducer when I'm looking at the underwriting. Whereas if I go in my backyard in my state, I may know everything about all the rents and expenses and insurance and taxes, but it's still a low cap rate situation.
Yeah. And it's definitely, I think, a safe position to take that I'm just going to look in my backyard, because especially for your first deal, for people that are going after their first deal, even the first couple of deals, I think it's important to have something that you can drive to, right? That you can see on a daily basis or weekly basis if you need to be intimately involved with the property. That's why I recommended to Manesh that he go up and move to Chattanooga for, you know, for 2 years or a year that he was up there just so he could get intimately involved with the property. So that's a good
Yeah,
point.
I mean, for sure, I think the best bet is to be so close to the property that you can
Yeah.
make random visits without the property manager finding out. And second of all, you need to be in tune with why the units are not renting or what kind of
Mm,
problems the property is facing. So having the property in drivable distance is literally a very important part of making those decisions. But my special scenario is I'm in South Florida. My neighborhood is Miami, right? So it's very
right.
artificially distorted. So you know, in Atlanta, I would choose to buy in Atlanta and Birmingham. Birmingham is 3 hours drive away. You know, I would do that. But South Florida is massively distorted for some reason.
And how do you go about representation from brokers that are putting deals in front of you on a national level?
So you got to underwrite the deals, right? I mean, the thing is, I'm consistently finding out that the brokers are 20% above where I want them to be. Like, I am it, I'm not able to submit any LOIs for anything above 80% of the asking price from my current underwriting.
But my question is, how do you have brokers putting deals in front of you on a national level? Meaning, like my broker relationships here are in Michigan, unless they are a national company such as CBRE or JLL or any of those players, they don't have accessibility to listings nationally unless they're on CoStar or they are on LoopNet or Crexi or any of these platforms where they're no longer in control of the listing. They're just looking at somebody else's listing at that point.
I would say they do. Just go on Marcus Millichap's site and put in the states. So go on CBRE, go on Cushman Wakefield, go on Berkadia, Walker Dunlop. You go to their site, you put the state you're interested in, and it shows you available properties and it shows you the broker on record and the person who's selling it. And what I normally do is I sign the NDA to access a deal room on their sites, and they immediately start calling out to me.
Mm, yeah.
I see what you're saying.
I've had people call out to me from Alaska and Hawaii. You know, I mean,
Good.
they're desperate for deals right now.
But
Yeah.
your search criteria is mainly on the national player websites, whether it's Berkadia or Marcus Millichap, etc. You're not active on Crexi or CoStar looking at deals.
I have accounts with both Crexi, not CoStar. CoStar and Crexi are competitors. I find CoStar to be a little bit more expensive. I think Crexi is something that's very attractively priced. Crexi does not list anything above like 20 units, unfortunately. In commercial real estate, the big problem is these guys are not like it's not like an MLS system in commercial real estate. Everybody
Right.
kind of guards their own listings. So Marcus Millichap will not allow anybody else to see it. But if you go to Marcus Millichap's site, you will see their listing. If you go like you have to go to each broker's site on a national level. I do deal with the smaller level brokers like Franklin Street and Capstone. I think disappeared. I think
Yeah,
Capstone
they
doesn't
did.
know
Yeah.
it folded. There's a bunch of these guys, SVN,
Mm,
Capstone, but they're such small players that they can't compete with the Marcus Millichaps of the country. I mean, these guys are huge, and they have they have these great teams that build the offering memorandums, and they spend 50. I think they spent $50,000 building the offering memorandum, and they've got amazing
wow.
reach to potential buyers, and they
Which
do
one,
all kinds.
Manesh?
All of them, Berkadia,
Yeah.
Marcus Millichap,
I mean,
Walker Del.
because they are a data mine. I mean, they have so much data, and they just have an army of analysts calling sellers on a daily basis of like, hey, do you want to sell your property? Hey, do you want to sell your property? They, hey, let me do it a BOV, right? What's a BOV? A broker opinion of value. Let me do a BOV for you just to see what we can sell it for. It's cutthroat, man.
Yeah, I mean, my guy, Pat Cosgrove, he's killing everyone in Nashville. He's a small-time guy in Marcus Millichap, and I spent weeks in Nashville meeting all the brokers, and I was cultivating a relationship with Capstone. They closed doors on me, and I was with a guy called Jordan Arand, and Jordan Arand was shunted to Northmark, and then there was another guy, Brian something Kelly. He was with another, but nobody's getting me any deals other than Marcus Millichap in Tennessee and Kentucky.
Mm.
So somehow these national brokers are snagging all of these sellers. Even at
It,
Daytona Beach, I'm
yeah.
finding, well, there's one guy, it's EXP Realty or something small. It's some franchise realty. They're coming out with deals, but if you go a little bit deeper into Northern Florida, like Orlando and all that, you get only Cushman Wakefield and CBRE that rule the show.
Yeah, it's almost about just market cap, right? Or market, what's the word I'm looking for? Like they've got control of the market in those areas. And sometimes you will find a one-off deal at like a Keller Williams, right? Like a residential shop that only does residential. They'll have like one guy like is the commercial guy or he got referred to this. So whenever I see that, I actually take advantage of that and say, okay, well, you really don't know this game very well. Like, and try to
And neither do the owners.
Right.
For that type of representation.
Exactly. They're hiring Keller Williams. It's like, okay, you really don't know what you're getting into with this. So if you can find those little nuggets, that's good too.
Those are the best, I think. You
Yeah.
can get them on Craig C and Keller Williams. You want those mom and pop sellers, right? They don't have any legal representation. They don't really have a clear idea of how to go about selling their properties, and they engage their friend or someone they know in these smaller shops. That's a great deal, according to me.
Yeah, I agree. Yeah. Yeah, and sometimes like LoopNet, you guys heard of LoopNet, right? That's kind of the aggregator. I think it's owned by CoStar now, but that's where a lot of people I've heard, that's where deals go to die. If it's on LoopNet, that means the big brokers have already gone through it. They haven't gotten any bites, and now they're going to put it out on LoopNet. That may or may not be true. I think some brokers will just put it on LoopNet as a matter of course, but like you don't really see Cushman and Wakefield putting deals on LoopNet, or even Marcus and Millichap, I don't think, putting deals on LoopNet. But you can find some gems on LoopNet. You just gotta dig through the data. Oh, it's almost 6 o'clock. Let me go through market analysis, risk management. Let's see where we're at. Again, just a couple of slides on mitigating risk in commercial real estate, right? How do you do that? Diversification in your portfolio, thorough due diligence and research of the property, markets, tenants, things like that. Your risk assessment, that really comes to property condition, hiring the right property manager, tenant credit worthiness, things like that. What is your contingency plan? How do you stress test vacancies, property damage issues, changes in the market? What is your plan if that happens, right? Especially if you're buying kind of rougher deals where the tenant base can be a little, dicey. In some of those instances, you got to have a really, really strong management team in place and be able to, like in Atlanta, probably all over the country, the COVID eviction moratorium was a huge issue. Right? I mean, even in Atlanta to this day, there's still some properties that are like the courts are just so backed up from COVID, they won't evict people. So and so that's just a big problem. I don't know, I think this was a Georgia thing. They actually created a law where property owners could hire like private police officers to go do evictions privately. It was crazy. Kind of like the Wild West. I don't think they have that in other areas.
Guys, I have to dip after right now. I got a parent-teacher conference at 6:15. I got to make it to. So I do appreciate the call today, guys.
Take care, Amber. Talk soon. Bye.
Diameter.
And I'll finish up here, guys. Just have a couple more. Good picture of Bezos here. I read recently he uses the same desk that he used when he started Amazon.com. But he's known for his strategic approach, undervaluing properties, utilizing data-driven market analysis, and implementing property management techniques. So what are our key takeaways? You got to understand the key investment terms. You got to understand financing options, how to value properties, how to calculate the returns, conduct your market research thoroughly, implement the risk management techniques that we've talked about, and then learn from successful investors. That's what you're doing here in groups like this. I think that is it. Yeah. So I'll throw this up on the school platform as well, guys. And let me see, what am I? Yeah, I'll throw this up on the school platform as well. Any issues that come up, be sure to call me, text me. Manesh, I forgot, I'm gonna add you to do you have Telegram, the app Telegram on your phone?
Yeah, I do. I do.
Okay, we've got like a group chat going on there as well, so I'll add you to that. I forgot to do that.
Yeah, I was wondering if there was a group chat. That's great.
Yeah.
Appreciate it.
Awesome.
Did you were you able to send that PowerPoint from the last presentation? No?
I did, but if I didn't, I'll make sure to get that done too.
Okay, thanks.
Awesome. All right, guys.
And I sent
Yeah.
you an email too. I don't know if you had a chance to.
Ooh, let me check. Where are you? Got it. Yeah. All right, I'll take a look at that, Benoit.
Okay, sounds good.
Awesome. All right, guys. Take care.
Yeah, you too.
All right, bye.
Thank you.